trading range. By the way, now that I've talked about the buys, let me talk really quickly about the duration. This could be just a preview of what's ahead for those of you who's going to kind of graduate to more advanced level. Think about the increase of the supply. Is it a lot of supply or not a lot of supply that comes in on this change of character? Probably not, right? So increases, but not substantially. So what could we say about the level of the supply? The level of supply is average. So therefore, we are not expecting that the duration of this trading range is going to be big. It's not going to take a lot of time to observe whatever supply is coming. So duration is probably going to be not that long. And we see that on the next, attempt to go down, there is a test which looks like phase C, sign of strength, backing up action, and off we go to the next change of character, which is somewhat hard to see here, but if we would be thinking about the rally into the sign of strength, comparing it to the previous rally, we would see that it's much better as a rally in this trading range, that the reaction is more horizontal, so that suggests a change of character. And within the context of the previous range, which we thought was a reaccumulation range, and then the context of the uptrend, we are saying that the change of character acts as a resumption of uptrend. Why is this significant? Well, because this is where we're going to originate our positions. This resumption of the trend, of the uptrend, gives us a timing. It's a timing tool to consider that now is the time to go in and open the position. In the assumption, it was an assumption that there's going to be a continuation of the swing or continuation of the longer term trend. Okay, well, imagine that we've opened the position. And imagine that we open two positions. One is a swing position and one is a long-term long position, kind of like investment position, right? Or, we're just trying to catch a much larger swing. Our entries are going to be here, 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 and here. 4 points of entry on the way up. And then as we go through the uptrend, we see the break of that uptrend, and then we look at the reaction. And it's a little bit complex. It has ABC formation, or 1, 2, 3. For those of you who are familiar with Elliott wave, you will recognize this reaction. So look at this reaction and compare this reaction to every reaction that came before. What do you see? Well, I see that we're definitely overshooting, the distance with which the price travels to the downside. So this becomes the largest distance. Again, downward spread is increasing. We could see maybe some increase in the supply as well over the previous reactions, so the latest reactions, but it's not as significant. And again, we probably are thinking here that this is a reaccumulation. If distribution would come, it probably would look differently. Supply would be more violent and the price action would be more violent to the downside. We don't see that here. But we are concerned with this slightly lower low. Now, what happens next is so amazing because the next rally suggests a sign of strength being followed by the backing up action. And if we would look at all of the rallies in this trading range that precede, we could say that this is the largest rally. So therefore, the price behaves differently. And we want to acknowledge that, and we want to say that this looks like a change of character, and then the backing up action confirms that. So here we're thinking if this is a change of character, again, this is the timing for us to find points of entry in this area as our assumption about the trend is such that the uptrend will be resumed again. So if we are swing traders, our tactics are going to be such that most likely we're going to be exiting somewhere here. This is our last point where we're going to give up our position. And this is going to act as kind of like this local capitulation. And as we're closing the position on that particular bar, we will be a part of that capitulation. We still will have a really great trade. You know, this is the trade right here. And for a swing trader, that could be a great trade. Later on in the course, I will show you, or rather in the practicum, I will show you how to identify this action as a potential point of exit. This is all going to be associated with the climactic run into the stopping action of the buying climax. And I'll outline to you the spots where we're going to be exiting the position or scaling out of the position. But for the long-term investor, we still would stay in this position. There is, if the initial bias in phase A based on the supply signature suggests that this is still reaccumulation, then we want to stay in this position. Actually, we want to add to the position, and we will be really heavily adding here and then somewhere here on the breakout. So these are the two spots of short-term weakness in the context of a much larger trend, long-term uptrend, that we will be looking for the long-term investor to add to the position, and for the short-term swing trader to establish the position for the next swing. Now, couple of you, before the class, we're talking about, yourselves. And by the way, guys, could you please email me like one paragraph on who you are as a trader, what do you trade, and then what kind of history was the Wyckoff method you have, and also how did you hear about our course? Just let me know the source. I would really appreciate this, and send that with your homework. Don't send this as a separate email. Or if you want to send it as a separate email, that's fine as well. A couple of you identified yourselves as long-term investors, and the question about the course was, well, is it going to be helpful to me? Well, hopefully, even from this picture, you kind of could see that it should be extremely helpful, because we will be discussing, obviously, original accumulations, but here, in the trend itself, how do you decide, are you still staying in this position as a long-term investor or not? Where potentially could you add to the position? Those are also very crucial places. And then where do you actually exit? So look at the next change of character that comes. It seems like all of the reactions here, which is 1 and 2, are of the same magnitude. And then suddenly we have such a huge reaction to the downside. This is by far the largest reaction, not only on the last leg up, but actually since the lows in the potential phase C here. And not only, when we look at this reaction, we would be thinking, okay, well, is the trend done? Is the uptrend done? And at this point of time, because it's a much more substantial reaction than what we've seen before, we probably would conclude or make, a couple of deductions here. Our first deduction is going to be that, well, first of all, after the change of character, we're definitely going to experience a non-trending environment. That's number one. Secondly, because of the size of the change of character, we're probably going to say that that trading range is going to increase the duration than anything what we've seen before. So therefore, the timing comes in as an element of our analysis. So this is not necessarily in the methodology. This is something that I've developed with the advanced students in the practicum, just addressing exactly this question. What about the duration of the trading range? So, and it's not necessarily common knowledge. I know that Bruce does not use this. I know that other, Wyckoff experts do not actually use this, but it's a very hard, evidence, that we see even on this slide alone to make some kind of assumption or judgment about the duration. The smaller the change of character, the smaller the duration of the range. The larger the change of character, or the larger the presence of the supply, the longer it takes time to absorb this supply. So therefore, duration of the range is going to increase. Okay, what other assumptions could we make here? Well, obviously, assumption on the bias is going to be something of interest to everyone here. But at this point of time, we would just have to say that it looks like the selling has come, but it's not, extremely heavy. We're still going to be under the initial assumption that this is a reaccumulation. And then we either going to confirm it through the price action in phases B, C, and D, or we're just going to reverse our bias, and this bias, original bias, which is to the upside, is going to fail. And then with this failure, we're going to say that most likely we're in the distribution. So this has to be, confirmed as well as we go through the whole trading range. Okay. Well, hopefully this is simple and understandable in terms of the first major concept that we want to work with. Change of character, again, is an extremely important concept, and that's why I'm teaching this concept first. I did not even talk about, let's say, accumulation or distribution in general. Let's look quickly at another example here. Excuse me. Need my water. We are again talking about Yahoo, and this is a daily chart. 2002, 2003 lows as a trading range, and then look at how the first momentum lag is identifying urgent buying by institutions. And those are predominantly trend followers. And then look at the backing up action here. It's not just flat, it's actually sloping up. So there is a lot of structural strength in this reaction by itself. And it happens on the background where supply is the lowest supply within the whole range. So that was a really good trade right there, or a point of entry. And by the way, for those of you who are extremely picky about, all of this stuff, and which I want you guys to be, because I am the same way. You might be saying, okay, well, where is this sign of strength? If you're talking about the change of character, like this is a change of character, but where is that sign of strength that should overcome the point of the resistance? Well, you're looking at this in a slightly different way. So look at the lower high, lower low. So what does this look like? This looks more like a triangle. So the backing up action actually comes exactly to the point of that sloping down resistance, and therefore, it's all in line with the sign of strength and the backing up action. This characteristic we will study later. Characteristics of apex and what kind of sign of strength and the backing up action there we could expect. As the price goes up, look at the texture of all of the moves up and the reactionary textures. So reactions are either flat or non-significant. And then the moves to the upside have some kind of deterioration of the momentum. So we have first a lot of momentum off the low, then continuation of that momentum. We still see some buying here, in this area, so that's great on the way up. And this is how institutions, trend following institutions, are getting into the position. They're assessing at this point of time, the bias, the value proposition that they have, the liquidity that is available to them at this point of time. And because they are already late to establish a position at the level of support, what they are going to do here is they're going to be buying on the way up. And this buying on the way up is going to look like this. So obviously this is buying off the low, and also we could say buying on the way up by itself. But after the first initial momentum buy by institutions, this is what we're going to see. So there's going to be fewer institutions, that's number one. Secondly, this buying is going to be on the way up, so it's going to push the price up. And as we understand these concepts of the initial momentum buying and then just continuation of this buying throughout the trend, then we could see that momentum on the next rallies is fading. And we don't see as much buying behind, those waves. So we could expect some kind of stopping action, buying climax, and then a change of character. So how would the change of character look like? Well, obviously it's going to look different from what we've seen before, from the reactions that we've seen before. Look at those. Do you see how different the latest reaction is? So right away, we are noticing that, we are making a note here, and at this point, we are going to say, we're going to make a couple of deductions. Change of character, and here also a small break of trend as a confirmation of that. It means that it's going to be a trading range. We don't necessarily see a lot of volume signature that is different on the reaction. So we're going to assume at this point that the bias is still up. And again, remember what I said. Don't take only these words from me. That the first thought is going to be, oh, it's the same bias as the trend before, just because supply is not there. We need either to confirm or reverse our bias as we go through the range. And the reversal of the bias could happen many times, in a lot of stocks, because it's not always there's going to be some kind of continuation, of the previous trend. So at least here, what we could deduct, is that we've experienced the buying climax, a change of character, and therefore an automatic response or automatic reaction in this case. And we could form a trading range by applying the parallel lines to the buying climax, and this is going to be our resistance, and support, which is going to be defined by the low of the automatic reaction. Our next assumption is going to be by Wyckoffian structure. We're going to ask ourselves a question. What comes next? Well, obviously, if there was a climactic stop in action, there is still going to be some momentum to the upside that we need to check. Right? So we're expecting a secondary test in phase A. And as we've talked about secondary test to the sell-in climax, that there are three types. We also think that there could be the same situation for a distribution, where we could say that buying climax is going to define the point of resistance, and then we could have a secondary test that's going to have a higher high, or a secondary test that is going to have a lower high, or a secondary test that is going to be kind of on the same level or close to that of the buying climax. So the same structural options on both accumulation and the distribution. So, and you kind of could see, guys, already where I'm leading you with this. If you understand Wyckoff context, if you understand what I call Wyckoff layer on the analysis, on the structural analysis of the conventional technical analysis, you could anticipate things, the way how they should unfold, the character of those things to come, and more importantly, to understand, should I be trading in this environment or not? And if I'm trading, you should be understanding how you should be trading. So for instance, if I have been in this position and I'm a swing trader, then my decision making here is going to be very simple. I'm just basically looking for the points of exit. I could exit on the way up into the climactic action. I could exit on the change of character bar. I could exit on the change of character reaction. I could exit on the way up into this secondary test rally. There are quite a few spots to exit that we will be discussing as a part of this course. If I am a long-term investor, I'm still in this position. I still need to go through the whole trading range to define the potential bias and either to confirm that bias or to reverse this bias and therefore start scaling out. If I am a short-term trader and I'm not in this position, and I'm looking at this potential phase A as it unfolds, and I look at this change of character, I'm saying there is no swing opportunity for me here. This is just phase A. I still have to go through phase B and then phase C, and to define that bias, going into phase C. So I will not be participating, as a swing trader in anything what's unfolding right now. Having said this, a much shorter swing trader might be thinking, okay, well, I see that we've experienced automatic reaction. I'm looking for the secondary test. I see that supply is somewhat the same than at other spots, other reactions, and that the initial change of character actually was not that pronounced. So as we're experiencing a secondary test, most likely this test is going to be strong and therefore a higher high and will create probably some kind of upthrust opportunity. So how do I trade that? Well, I want to establish position here somewhere on the intraday basis and then trade through the resistance. And once I see first intraday signs of distribution, I will be out. But again, this is somebody who's going to trade on the intraday level, on the very, very short-term swing trading level. So in here, I went through all of the possible, traders and their requirements as to how they would be thinking about the Wyckoff structure at this spot. Well, let's see what happens next. So we said that supply was not that impressive, and then the change of character was not that impressive either, relative to this whole move. So most likely the secondary test rally is going to produce some kind of upthrust situation with the higher high. So that was great. We were correct on that. But we know by the Wyckoff context, by the Wyckoff layer and structure, that phase A is going to conclude with this secondary test, and we're going to go into a very volatile and predictable phase B. As we go through this phase, and here is my honesty and authenticity and my commitment to all of you guys, and more importantly, even to myself. And for those of you who know me for a while, and I see that some of you guys here are alumni, first of all, great to see you here. Great to have you in the class. Don't forget to give me some feedback as you've listened to me and to this course, maybe a year ago, maybe 2, maybe 3 years ago, maybe even more than that. Let me know how the course has improved and how else we could improve the course. I'll be very curious to hear. But my commitment to you guys is of the highest honesty. I'm going to tell you exactly how I'm conducting my trades. I will not hide my losses. I will not hide my mistakes. It is not my intent to do so. So when I say something, usually take it for what it is. Usually this is how I think, and this is the most honest answer that you could get from me. So looking into phase B environment and looking at the higher lows, I still, as a long-term investor, would be thinking that the bias here is to the upside. There is really nothing distributional about this pattern in phase B. Nothing. You don't have a lot of supply coming in. It's somewhat mediocre, average. And it doesn't produce, anything larger than the change of character, which is by itself is not such a, big retracements from the lows to the highs of the buying climax, from the lows of phase C into the buying climax high. So I'm still going to be thinking that this is a potential reaccumulation at this point. The only question here is just the timing. Are we in phase B or in phase C? If we're thinking in phase C, then we should wait. If we, if we're in phase B, then we should wait. If we're thinking that we are in phase C, then you're going to originate a trade somewhere here. And your point of exit is going to be this bar right here. So basically, you're going to have a break-even trade. Again, this is something that I don't mind for my own trading and for the trading of my students. What this trade does, it creates two levels of understanding. The failure of this trade creates two levels of understanding. The first one is going to be that the analysis is actually incorrect. And it doesn't matter whether the analysis is incorrect because it didn't really show us what it's going to be in the trading range itself. Sometimes the bias is so evident even in phase A, you can't really think anything else. But then in some instances like this one, you're going to see a lot of elements of outperformance like Yahoo was exhibiting in 2005 in phase B and phase C, and you might not distinguish this as a potential distribution. In the first class, in the first lecture, I have shown you an actual trade in Novadear that I did just recently, where Novadear as a leadership stock was exhibiting elements of reaccumulation in what turned out to be, a distribution. The same here with this stock, with the same with Yahoo. Why is this happening? Well, because there is a lot of leadership characteristics on the way up, and they are not going away really fast in the trading range that turns out to be a distribution. So therefore, a trade like this, the one that I'm showing you here, is actually an okay trade. If you're not okay with this trade, then you are greedy, and something you gotta check with your ego, because we never 100% right in this craft. Trading is not about being right, all the times. Trading is about making money. There are no other goals. There are no other intentions but to make money. If you're spending time on this, you should be making money. If you're not making money, then you should make some kind of adjustment. Get more knowledge, get more skill, and develop that skill. All right. So as we go along this range, so what else do we see? We see an upthrust and then a failure. So it's right here on this failure of the upthrust. This is where we're gonna start thinking like, what is going on? Look how supply is starting to show the picture of the distribution where supply is starting to increase. There is a lot of selling off the top. So usually that type of selling is always going to be institutional. So we might be thinking here that with the increase of the supply and the way how the price quickly reacts back into the trading range, we might be in some kind of either short-term distribution or in the much bigger distribution. So a short-term distribution would take us to the support level and maybe even below that level. And then that could be a trade by itself. You can establish a position somewhere here on the failed signal and then continue with this position until you see some kind of lower low. So exit here or somewhere here would be okay. And then you could wait. you don't necessarily have to continue with the short trade here. You could wait and you could see how the last point of supply is going to unfold. Or is it going to be possibly a spring? Because in some of the cases, we could have volatility going into phase C of the reaccumulation and then a move to the upside. So that's why we would want to wait and to see if there's going to be some kind of further failure and further behavior that is going to be associated with the distribution. Well, we talked about the changes of character, and that's the main topic today. Look at this reaction to the downside. Compare that to the reaction that we've seen throughout this whole trading range. Is it expanded? Yes. Is the down spread expanding as well relative to what we've seen in the current environment? And we see that those are the big spreads. The only spreads like this we've seen on the change of character itself. So that tells us that we definitely see some bearish characteristics here. Would the volume signature increase? Yes. Would the supply signature increase with that? Yes, absolutely. So we see in here a synchronicity, and this is just again, a WTC word, synchronicity between the downward effort, which is expanding, and the downward result, which is expanding as well. Therefore, the bias, at least short term, at this point, is going to be bearish. So, and please note again, let's be honest about where we define the bias. And let's be honest about even questioning where we're defining the bias. If you're going to say that, why you not define the bias before, let's say, the beginning of 2006? I'm going to honestly answer you that I did, and my bias back then was still to the upside in this area until it actually showed a failure. And this is where my bias has changed. And there is nothing wrong about changing your bias as long as you understand why and as long as you could use it and make money. So just something like, as we go through the material, guys, I'm giving you my belief systems about trading and about money as well. And you should make those notes somewhere. And just in general, a piece of advice, for those of you who are seriously studying this course, for those of you who are going to be spending, hours on homework, I'm going to push you a little bit more. And I'm going to say that your main homework should be not just labeling the charts that I'm going to give you, but it also should be making notes, listening to the recording again and making notes and sending those notes to me. What that does is, as you could see, I go through the material somewhat fast, and I'm giving you a lot of material. Yes, this material is being repeated over and over, but still, I'm giving you a lot of material. Our minds are just not capable of absorbing all of the material at the same time. That's what I've seen from students from cycle to cycle to cycle. It's not just you, it's very common. I cannot absorb all of this material, even of this session, like if it would be a new material to me. So therefore, watch the recording again, make notes, send those notes to me. So let's come back. So we clearly see some bearish activity on the possible change of character. We're assuming that this is a sign of weakness and that the next rally, which is not going to be extremely strong, is going to be a last point of supply rally. We're looking for the point of confirmation of this information, and this last bar actually gives us exactly that. By itself, this rally as a last point of supply rally is better than any of the rallies that we have seen on the change of character. So therefore, we might be even thinking that there could be another trading range here before we continue to the downside with the bias, with the overall bias that started with the upthrust here. So therefore, we could be either entering a position right here. This could be our point of entry. But the very vibrant rally suggests that demand is there, and this demand is probably of weak hands. But increase of the demand as increase of the supply will always have to have some kind of test or retest. So we are thinking that maybe there's going to be some kind of test again at this level, and there's going to be another point of entry for us here. Okay, well, let's see what has happened. Ooh, and I don't have this. How come? Okay, apologies. So if I remember this correctly, you guys could check out on Yahoo. I think it's been discontinued, but still, I believe we had some kind of trading range here, and then we went to the downside. So that was the history. Okay. All right. So important concept on the change of character. Uh, if you did not fully understand it, please rewind the recording, listen to the recording again, stop at the spots that you don't understand, rewind it, listen to it again. If you don't understand still and have a question, email me and we'll just go from there. Okay, all right. Let's talk about accumulation. So that's the next question for us, right? Because as we think about a change of character, which is basically, from, let's say, an accumulation, a downtrend changing into the non-trending environment, into the trading range. As we enter the trading range in phase A, the biggest question from students, and it's just funny how it is, I would actually never be thinking about this question because there are so many things that are going to still unfold as consolidation unfolds by itself. But that question is always about the bias. So students always want to know what is the bias. Again, as I mentioned before, the advanced studies, which we're going to do, in the practicum course, are going to address this question to a certain degree, not necessarily to the fullest degree, but to a certain degree. But for now, what I want you to do is just to think of a change of character as a change of the environment, and then once we're in the trading range, that's when we want to observe how it unfolds, and we want to solve this problem of the bias, the timing, when the price is getting out, so therefore identifying phase C and D correctly, and then the character. And usually the character is going to be all about the leadership and the way how the price is going to travel, what kind of structure it's going to give us. So how would we do this? How would we define accumulation? Well, there are a couple of things that are going to help us out. The first helpful thing that Wyckoff method, and this is the value of the Wyckoff methodology, by the way. I was talking to Bruce the other day, and I was telling him that if you think about the Wyckoff method, all of the elements, the most important concepts are all on the level of price structural analysis. Everything else is just more in depth on the technical analysis concepts, and I recognize it could be more in depth. Let's say when we talk about the volume, I meet very rarely people who don't know about Wyckoff and they talk about the volume on a very high level. But majority of volume guys are going to be all about, some kind of Wyckoff background. But predominantly it's all about, the structure and how it unfolds. So we'll talk about the phase analysis. And phase analysis is extremely important because Phase analysis gives us the timing. It gives us to a certain degree the bias as well. But more importantly, it guides us through the process of how trading range unfolds. And we know that a specific phase is going to have specific Wyckoff elements, specific Wyckoff events, and those Wyckoff events are going to unfold in a specific way, and that could give us a hint for the bias as well. So what do I mean by that? What do I mean by this phase analysis and how everything happens kind of in the same way? Well, let's talk about phases, and let's start with phase A. And we spent some time already on phase A. We said that in phase A, we have the conclusion of the previous trending environment, in this case, a downtrend. And it's going to conclude with 4 points. The first one is going to be always failed attempt to stop the price from moving further down, and it's going to be our preliminary support. So here's on this slide something that I want you not only to read, but I want you to remember. I want you to memorize this, to the majority of it at least. I want you to memorize this sequence of events that are going to come in the trading range. This is one of the mistakes that students make a lot. So I want you to understand that first is going to be preliminary support. That's going to be followed by the selling climax. That's going to be followed by the automatic rally, then secondary test, and so on and so forth, from one phase to another. I want you to remember this sequence of events, how trading range unfolds. Coming to phase A. Coming back to phase A. Preliminary support is the first attempt to stop the price from moving further down. And usually, this is still going to be an institutional activity and some institutional buying. Institutions at this point of time already seeing some kind of value, and some of them just a little bit more premature entering the position, which is totally fine with them because their time horizon is so long and big that even if they bought here and they sold somewhere here, this is still a profitable trade for them. Also, please think that there could be scaling into this, and they could buy more at the selling climax and kind of average down, and then turn out to be averaging about 1/2 of the trading range or even below that. So quite a few different ways of how institutions could start accumulate, and preliminary support is going to be one of those initial first points where institutions could establish a position. Then this preliminary support definitely going to fail. Preliminary support, preliminary supply points will always fail. You will always see either a lower low for the selling climax or a higher highs for the buying climax. If you are labeling it as a preliminary support, which is the lowest point on the chart like this is wrong. So this is incorrect right away. So selling climax is going to come, as I mentioned, as that panic from weak hands. And again, weak hands at this point, and this is more of the general capitulation. So at this point, weak hands are not just public. And this is what's been taught to us, that weak hands are going to be public. No, that's not correct. Get this out of your head, especially those of you who've been studying the methodology for years and years. Weak hands are not necessarily just public. Weak hands are always going to be public plus institutions. Otherwise, we would not have such a huge volume signature on the selling climax. Public cannot produce, overextended volume spikes like that. So on this general capitulation, the volume signature is going to increase dramatically. Supply is going to increase dramatically. Demand is going to increase as well, and that increase of the demand, that's what's going to start absorbing the supply. This is initial absorption. And who is absorbing? CO, composite operator, composite man. And then as this absorption happens, initial stopping action happens. And this stopping could be having such different variations. Momentum could slow down, but price could still go down at the same time. You could have situations where, let's say, there is a deterioration of the supply, price still goes down. You could have a stopping action by itself where you have a spread that is decreasing by the spread, daily spread, and it's decreasing significantly. At the same time, the volume signature is spiking up. So what does it mean? That means that there is a force that pushes the price down, and there is a force that pushes the price up. So supply and demand increases at the same time, volume signature increases dramatically, but yet there is no progress. The result is kind of the same. So that is a stopping action. And then, another one on the increase of the demand, you could start seeing the price actually not just stopping, but start moving up. So that's the whole process behind the selling climax. Again, obviously, the most interesting part about this is the exchange of shares between weak hands and strong hands at this point of time. Both groups have different intentions. One group wants to get rid of the position because the emotional pain is too much. Another group is trying to establish the meaningful position because there is a point of liquidity and value to them. All right. After the selling climax, as the supply is being absorbed, that produces automatic response, which has not just the buying by institutions on the way up, but short covering by professionals that pushes the price up. And that establishes a change of character and establishes the high for automatic rally, the low of selling climax, and therefore establishes the boundaries for the trading range itself, establishes the resistance and the support lines. This is a very valuable piece of information. Actually, I've given you today so many great tools on how to think about the change of environment and how to establish the trading range and how your decision making at those spots are going to be tested by all of these events. So I want you to understand all of this. I want you to memorize all of this, because as we go along and we're going to go into much deeper stuff, especially with supply and demand, I want you to think about the definitions. I want you to know them. So very valuable information with the resistance and the support lines. Why? Well, because for the majority of the duration of the trading range, this is where the price is going to reside. It's going to have some points where it's going to go into the oversold condition or overbought condition, and it's going to create low lows, higher highs, but that's not that important. The majority of the deviation of the price is going to be still around the mean that was created by that phase A. You might have some slope to the upside, to the downside, but predominantly it's going to be horizontal. So therefore, think about the trading strategies that you're going to have here. If you're an option trader, your strategy is going to be collection of options and very short duration kind of weekly options type of directional trades. If you're a long-term investor, your goal is here to identify the bias of the whole formation and timing, identifying phase C and phase D as your potential points of entry on the emergence of the trend. If you're a swing trader, then most likely this is not even going to be the best candidate for you even to be in. But if you're a very, very short-term trader or just oriented for this specific stock, then you could have some directional trades, and those should be originated at the points of resistance and support, so around the edges of the range. All right. So as we conclude our phase A with secondary test, which is again a local test of the climactic action, it basically asks a question: do we still have a lot of supply left from the downtrend, and the last leg in this downtrend, the capitulation into the selling climax? And if we don't see that continuation, and we see the reversal, then it confirms a change of character by itself. It confirms the idea that we are in the trading range, and we also will start thinking about phase B and how that phase should unfold. We will be talking about the intentions of the trading range, of the phases in the trading range, and that is also something that I want you to remember by heart. The intention behind phase A is all about stopping the previous trend. In the accumulation, you will be stopping the downtrend. In the distribution, you will be stopping an uptrend. And therefore, the intention is just to stop the previous trend. In phase B, we're doing two things. We're building a cause, and building of a cause happens because there are so many fluctuations in phase B that we could observe. And those fluctuations are just a kind of reflection of buying and selling by different groups. And through this buying and selling, what is happening in phase B in the accumulation, it's the further process of absorption of the supply that is going on, that is happening here. And it's not going to be extremely visible. And again, this is something that I'm going to be extremely honest with all of you guys. This is not a linear craft. This is not a linear analysis. This is something that it only could become linear if you understand all of the variables, and unfortunately, we can't even comprehend the number of variables that influence the movement of the price of a single stock. But what we could comprehend is the way of how patterns should unfold. And we're obviously saying the pattern will unfold with different variations. And those different variations is going to create different structures, and we have to make sure that we understand the process with which the trading range is going to unfold. So in phase B, there's going to be still in accumulation that process of absorption that is not going to be extremely visible to us. In some instances, it's going to be extremely visible. We might have some, elements of strength, let's say, as a sign of strength, and we're going to say this is a minor sign of strength, and it acts as an upthrust action in the possible accumulation. And then we're going to see a very laborious move to the downside in phase C, maybe into the higher low as a last point of support rather than a sprint with the lower low or a shakeout. So those are going to be extremely visible to us. But in some instances, they will not be. And what we will have to do is we will have to make the best judgment in phase B and then look into phase C and D as a confirmation for that bias. And this is as honest as I could be with you. And one more thing that I'm going to say here. You will make the mistakes making that judgment call, and that's okay. You make the mistake, you post-analyze this, you understand, was this an analytical mistake or systematic mistake, or was it a trader mistake, my mistake? And then you address that. You make an adjustment. If there's something new on the analysis part, you take that chart, put this in your library, you bring this chart to me, we discuss this in, either in session number 15 or in the practicum or somewhere else, and we will understand it better. But those things will happen. So phase B also, as I said, building cause through this buying and selling waves, and then it's all about the supply and demand. Is there absorption happening, or maybe supply is very dormant, but the quality of the demand is not there. So what does that suggest? Probably suggest a continuation rather than a reversal. So again, something that we will be discussing and practicing and developing the skill to recognize. Then we go into phase C. And phase C is the most important phase in the whole trading range for me. Why? Well, because it's the last test at the level of the support for accumulation and reaccumulation. And what is it testing? Well, obviously, it's testing the availability of the supply. It's testing the availability of the demand and the quality of the demand at the support level. And if we would be just thinking about the testing of the previous price action, then the test is definitely oriented toward testing the support in phase B and toward testing of the support in phase A. We want to see if the price not only can commit to the downside, and I'm not talking about the temporary commitment where we have one or two closes below the support level and then instant resumption, of the upswing. No, I'm talking about a more meaningful commitment to the downside. Ironically, the current market shows a lot of those spots where there is, a significant commitment to the downside, and yet even that could act as a shakeout. And we kind of seen how the market is reacting. Uh, in the mornings, the behavior is always sell, and then into the close, even today, into the close, we're seeing some kind of move up. So whatever supply comes in on the discounted news from overnight or from over the weekend, it's still, some buying that is present there. We are at the very kind of like interesting spot where we could have a reaction, but we also, if the price action is going to be more bullish, we could continue with that move to the upside, or we could have a very shallow reaction. So we'll just have to see. But phase C is that last test at the level of the support. This is the test of the supply and the test of the demand at the same time. And this is a test number 3. I will come back to this idea. And this is a pure Romanism. That's how students call this. Because in the original course or GGU course, or whoever you took this course before, there is no mention of this. But I wanted to create some kind of shortcuts for you guys in order for us to just understand the concepts. And I will develop, the idea of why test number 3 later on. But for now, I want you to remember that the first test is going to be a local test of the climactic action to the selling climax. That's test number 1. That's in phase A. The test number 2 is going to be the test of the support area in phase B. And then test number 3 at the support level is going to be the test of the last point of support, the test of the sprint, the test of the shakeout. And it's still going to provide us the clue that even if supply is available here at the spot, demand is capable of reversing the price back into the trading range and then pushing the price back to the resistance point. Our fourth test is going to be a backing up action. And this test is going to be at the level of support, but at the different level of support. This level of support is going to be all about a conversion, a switch from resistance to the support. And that test number 4 is going to confirm a change of character. Okay, well, if phase C is the last test, and it's extremely important to observe this test of the supply and demand at the support level and to seek the confirmation that the price comes back into the trading range and has characteristics of being able to move the price up on the bullish volume character, the bullish price character, and so on and so forth, then phase D already becomes a part of the markup phase or an uptrend. And usually when we look at the historic chart and you need to quickly identify phase C, what do? You look for the lowest point in an uptrend, and usually that's going to be your phase C. That's going to be a shortcut as well, and especially for the homework that I'm going to give you guys. So phase D is a part of the uptrend already. And in the uptrend, the behavior is going to be different. And we're going to experience that change of character again. As I mentioned before, the rally is going to be the best rally out of all of the rallies in the range. And then the reaction is going to be the best reaction in the range. And in a lot of cases, it's going to be more horizontal than the reactions in the trading range itself. And then after that, as we confirm the uptrend with the break